Welcome to the Deep Dive, where we take the world's most crucial research, strip away the noise, and really deliver the knowledge nuggets you need to understand where the global economy is headed. Today, we're jumping into the findings of the United Nations Conference on Trade and Development's World Investment Report, the WIR 2025. And this document is, well, it's our map for the next little while. We're looking at global foreign direct investment, or FDI, major policy shifts, sustainable finance, and the big one, international investment in the digital economy. Our mission is pretty simple. We want to pull out the key facts and connect the, frankly, surprising patterns that show a capital market in a really intense, rapid transition.
And that's where it gets so interesting. The core of the analysis, it's not just that overall investment decline, that 11% drop. It's not a simple retraction across the board. What we're actually watching is capital rapidly shifting priorities in real time. The pattern showed this massive divergence, a reallocation, and a concentration of funds.
A strategic pivot, then.
Absolutely. It's a pivot away from long-term, slow infrastructure and aggressively toward sectors driven by AI, by data, and, of course, by geopolitics.
Yeah.
And that divergence, that's the key insight for you to grasp.
Okay, let's unpack this then, starting with the headline numbers from Chapter 1. If you just read the top line, global FDI fell by 11% between 2023 and 2024. I mean, that sounds like bad news, full stop. But what does that 11% actually hide?
It hides a huge strategic shift. Think of it like a global investor pulling back from one asset class just to, double down on another. That decline is made up of these contradictory movements. So, for instance, International Project Finance IPF, the money for massive long-term public works, power grids, things like that, it slumped.
How much?
By 26%, a huge contraction.
Yeah.
And Greenfield FDI, so brand new ground-up projects, that also contracted by about 5%.
But investors weren't just sitting on their hands.
Not at all. To balance that out, cross-border M&A mergers and acquisitions actually increased by 14%.
So capital is still moving, it just favors, smaller, faster deal.
Exactly. Faster deals, acquisitions over these huge multi-year infrastructure commitments.
So why is that? Why does uncertainty favor M&A over something like a greenfield project? Is it just about speed?
It's a combination of things, but speed and risk management are central. M&A lets you consolidate and acquire existing tech and market share almost immediately. Greenfield projects, on the other hand, they're just so vulnerable to economic uncertainty, to supply chain risks, rising interest rates, all the things that make long-term financing more expensive.
And the report points to some key drivers for this.
It does. It identifies three. First, the explosive growth of AI-driven business models. That's just driving insane demand for data infrastructure and ICT.
And the second, I imagine, is geopolitics.
A huge factor. Geopolitics and very proactive industrial policy. Governments are using incentives and restrictions to basically force a restructuring of supply chains.
Pulling investment into strategically safe zones.
Right. And the third driver is just that persistent economic uncertainty, which really encourages the shift to M&A and contributes directly to that slump in the big IPF deals.
And this is where the data gets really stark, isn't it? When you look at the sectors, the primary sector investments there fell by almost 50%. Meanwhile, greenfield projects and data centers and semiconductors, they jumped by 73% in 2024.
And that's often with heavy support from those new industrial policies. The acceleration towards digital is just undeniable. Investments in digital industries grew by an even more staggering 107% in the same year.
Wow.
And you can see this shift in, who holds global power. The ranking of the top 100 multinational enterprises, the M&Es, it's changing. You see fewer traditional utilities, less manufacturing, and more tech firms dominating that list.
Let's talk about the geography, because that concentration really matters. It shows how global vulnerability is growing in the regions being left behind. I mean, look at the disparity between developed regions. FDI in Europe saw 44% contraction.
That is a massive, massive capital flight. You have to ask what's driving it. Higher energy costs, complex regulation, maybe a perception of weakness compared to the U.S. market.
And at the same time, North America, it increased its FDI by 23%.
You couldn't ask for a clearer picture of regional divergence. It's night and day.
And that divergence is just magnified when you look at the developing world. FDI inflows there, they stayed stable overall, but they were so concentrated.
Highly concentrated. 10 countries accounted for 75% of the total investment.
So everyone else is fighting for the scraps.
Pretty much. And the weakest economies, the least developed countries, they were hit especially hard by that drop in infrastructure investment. And to connect this to this so what, this whole reallocation of capital is just hammering sustainable development. Rising geopolitical tensions contributed to a 26% decline in SDG-related FDI.
So in real terms, that means a quarter less money for projects on global health, on education, clean water.
All because investors are spooked by geopolitical risk. That's the critical takeaway. Infrastructure and renewable energy projects, they make up 80% of all SDG-related FDI, and they saw a one-third decrease. So capital is seeking speed and safety in digital, and it's abandoning the slow, difficult work of global development.
Okay, we've seen how the money is moving, so how are governments trying to influence these flows? Let's turn to the policy shifts in Chapter 2. Globally, it seems like three-quarters of new investment policies in 2024 were actually favorable to investors. Things like incentives, liberalization.
That's right. European countries, for example, introduced a lot of schemes to encourage renewable energy investment for their net zero goals. But, and this is a big but, we have to look at the other side. Just over a fifth of new measures were restrictive, and those are driven almost entirely by national security and the race for tech leadership.
And where are those restrictions coming from?
Mostly from developed countries. In fact, Canada and the United States accounted for over one-third of these new, less favorable measures in 2024.
We're talking about things like the America First investment policy, right?
Exactly. Initiatives like that, which are designed to shore up domestic industrial bases.
So the main tool here isn't tariffs, it's these foreign direct investment screening mechanisms. What are they trying to protect?
They're essentially regulatory tripwires. Governments are using them to screen incoming foreign money to safeguard priority sectors. Think AI, clean energy, quantum computing. But they're also increasingly used to address concerns about access to critical raw materials and sensitive data, personal genetic, biometric data that could be a security risk.
You said most regions were adopting favorable policies, but North America was driving the restrictions. How significant is that disparity?
It creates a lot of fragmentation. While most regions were opening up, most new measures in North America were in fact less favorable to investors. This trend is expected to continue, and it could end up splitting global investment flows along geopolitical lines.
Okay, moving on. Let's look at the sustainable finance landscape from Chapter 3. The WIR calls it larger and more sophisticated than ever before, but also fragmented. I mean, the overall size sounds huge. Publicly traded sustainable finance products hit over $8.2 trillion in 2024. That's a 17% increase.
The aggregate numbers look good, but they really do hide a lot of investor caution and, frankly, integrity issues. We see huge fragmentation across the different instruments. Sustainable bonds, for example, they showed strong, consistent expansion. They topped $1 trillion in issuance. And green bonds dominated that space, making up about two-thirds of it.
And that's because they're tied to specific verifiable projects, right? Like a wind farm.
Exactly. Investors like that tangibility. But the counterpoint is in the other bond types. We saw major concern over sustainability-linked bonds, or SLBs. They declined to their lowest level since 2020.
And the problem there is that the targets are often seen as weak or easy to game.
That is the core issue. The decline reflects these ongoing worries about greenwashing, about weak targets, and just a lack of common standards. Investors are wary they aren't buying real impact.
And we see that same kind of stagnation in sustainable funds, too. These assets grew to nearly $3.2 trillion, but the net inflows. They fell for the third year in a row, dropped to only $37 billion. That's 40% below 2023 levels.
And if you compare that $37 billion to the $1.4 trillion in net inflows to the overall global fund industry, you realize just how subdued this segment is. It's struggling.
And the geographic split here is just so stark. It really shows the political fault lines. Europe holds 84% of global assets in sustainable funds. Meanwhile, the United States recorded net outflows for a second year in a row amid regulatory uncertainty and this political backlash against ESG.
Right. It's become a political lightning rod in the U.S., while in Europe it's, just business as usual. And this difference is also reflected in carbon markets. They're growing, but with huge integrity differences. Voluntary carbon markets are challenged by integrity problems. Compliance carbon markets, on the other hand, show much more robust, policy-anchored growth because they're mandated and monitored by governments.
So the regulatory picture is clearly split. The EU is the front-runner in setting standards, while the U.S. is characterized by, as the report says, regulatory fragmentation and backlash.
But there is a huge positive detail that often gets overlooked. Developing economies accounted for roughly 60% of new sustainable finance policy measures in 2024. They are being really proactive in trying to attract green capital.
So even though they're suffering from the funding shortfall, they're the ones pushing policy forward.
In many ways, yes. But the big picture from Chapter 3 is that while sustainable finance is getting bigger on paper, the fragmentation and headwinds are severely constraining its ability to actually support the Sustainable Development Goals.
All right, now let's get to our deep dive within the deep dive. The thematic chapter on international investment in the digital economy. This sector is expected to grow 10 to 12% annually. It's a central driver. But there's a huge fault line here.
A huge one. The central challenge is that investment is still critically insufficient for what the world actually needs. The global funding gap to achieve universal digital connectivity by 2030 is estimated at $1.6 trillion. It's a staggering figure, and current investment patterns are nowhere near closing it. We're accelerating the tech, but widening the access gap.
And on top of that, you have extreme market concentration. It's an oligopoly, really.
It is. The top 100 digital MNEs are mostly domiciled in developed economies, especially the US and China. They control the infrastructure, the platforms, the data. Even the emerging market MNEs, mostly from China and India, they have lower average revenue by about 28%, and their operations are much more regional.
And this geographic imbalance is critical for development. I mean, look at the numbers for physical infrastructure. Between 2020 and 2024, developing countries attracted only $36 billion of greenfield investment in core ICT and telecom infrastructure. That's less than the $39 billion that went to developed countries.
Who already have robust networks. So the developed world is investing in digital density for its own already connected populations. And even that limited flow to developing countries is highly concentrated. 80% of it went to just 10 economies.
So the regions with the biggest connectivity gaps, Africa, parts of Latin America, are the least attractive for investment. It's a paradox.
It is. And it has profound implications. We know the positives: capital, tech transfers, jobs. But the report really emphasizes the negative impacts.
Right.
Well, first, high market dominance that stifles local innovation. Second, the literal expansion of the digital divide. Third, the unwanted environmental impacts, the massive energy and water use from all these data centers.
So UNCTAD is basically saying FDI needs to have a moral compass here. It can't just be about revenue growth.
Exactly. It has to take development and environmental impacts into account to ensure sustainable digital transformation.
And what are the policy recommendations?
They focus on 4 areas: setting clear regulatory foundations for data and privacy, stimulating investment, fostering local impact by upgrading digital skills, and finally using international agreements to ensure cross-border standards.
So to recap the core finding of this whole report, the global investment landscape is being completely reshaped by 2 immense forces: geopolitical uncertainty and this accelerated, concentrated shift toward digital AI-driven activity. And this has created these stark winners and losers. Digital industries are booming, while long-term infrastructure investment, especially in vulnerable economies, it's collapsing.
So what does this all mean for you as a global observer? The big themes are clear. Radical inequality driven by this growing digital divide, geopolitical fragmentation hardening into protectionism, and extreme market dominance by a few key digital players. The current pace and direction of capital flow is just insufficient to meet global demand for ICT infrastructure, and the regions that need the support most are being critically underserved. It's risking a major setback for global development goals.
Which leaves us with a final provocative thought for you to explore. The WIR shows that all this huge investment in ICT isn't necessarily closing the global connectivity gap. It's often just making the connected world faster. So if the digital economy is central to all future growth and we see private capital is unwilling to enter these high-risk, high-need regions, how can governments and multinational enterprises fundamentally restructure their strategies? How do they prioritize reducing the digital divide and actively drive the SDG agenda forward instead of just making existing inequalities even worse? We'll leave you to chew on that one. Until the next deep dive.